They will never let the curative effects of a free market go through and cleanse the market from all the excesses. They won't let that happen. And if they try, the market will then exacerbate the situation until the rescue efforts materialize. So, no, they're not going to do that. They are going to continue to manage the economy by setting the price of money because they can, and of course, because they know better.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today, we have a fantastic discussion lined up. We're fortunate to have with us BRIEN Lundin. BRIEN serves as the president and CEO of Jefferson Financial, a highly regarded producer of investment-oriented events and a publisher of investment newsletters and special reports. Under the Jefferson Financial umbrella, BRIEN serves as publisher and editor of Gold Newsletter, the publication that has been the cornerstone of precious metals advisories since 1971. And he's also the host of the annual New Orleans Investment Conference, the oldest and most respected investment event of its kind, and the one that's getting ready to kick off here in just a few short weeks. BRIEN has more than 4 decades in the investment markets. BRIEN, thank you so much for joining us today.
Gary, great to be with you. I've really enjoyed your content and very happy to be in your program.
Fantastic. Well, let's get started. In the past 2 weeks, we've had 2 of the biggest titans in the history of Wall Street, Stan Druckenmiller and Paul Tudor Jones, openly discussing the inevitability of a debt crisis in the United States. Mm-hmm. Not only have they discussed the possibility, but they've even bet vast amounts of their own personal wealth on it by shorting U.S. Treasury bonds and by buying gold. Are we in a debt doom loop right now?
Yeah, yes, absolutely. This is something I've been talking about for really too long in Gold Newsletter. At least 6 years now. I've been talking about the inevitability of the debt service costs on the federal debt exceeding $1 trillion. The trajectory was really high back when I first started getting there, but we were far from it when I first started writing about it. But the key to that was that this put the Fed in a trap, in that the federal budget, the very foundations of the monetary system, couldn't survive interest rates at anything near normal levels, because after 4+ decades of ever easier money, ever lower interest rates, and therefore ever greater accumulation of debt, the debt load was too large now to ever have, for any sustained period of time, to have interest rates above the rate of inflation. So we would have to have negative rates of inflation going forward. That's precisely the trap that we're in right now. The Fed and the U.S. budget can't endure interest rates at 5% plus because of the cost of servicing the federal debt, also the cost of servicing corporate debt. We have a bunch of debt resets coming up in the months just ahead. Yeah. So the Fed is forced to cut with some urgency. Now, what's really interesting is that in recent weeks, the markets are fighting against that, and the Fed is kind of gradually losing control as we see the bond vigilantes coming back and saying, those yields are too low, given what we see are the risks, really not so much of inflation, but the risk of you being able to service the debt going forward.
Yeah. Do you view the current fiscal situation as irreversible and unsolvable by any administration? And if so, what are the ramifications of that?
Yeah, it is. It is irreversible. It is unsolvable. People have asked me, what should Fed Chairman Powell do? And I've said he should close his briefcase, walk past his secretary, and run. Buy gold, silver, and ammunition and canned goods and find a cabin in the hills somewhere, because there's no way out of this. There really is no way out of this. We can't raise taxes enough to close the deficit. We can't grow our way out of it. Really, the only thing that can be done is the age-old prescription of deflating away the deficit by depreciating the currency. And I don't think that's a strategy that anybody would undertake because it would demand far too high rates of inflation that any bureaucrat would undergo or would accept. So it's a kind of thing that just happens because your back's up against the wall and the gun's against your head. That is going to happen. We will have a depreciation of the purchasing power of the dollar and, in fact, every fiat currency around the world in developed nations. And the only thing that can be done is for investors, for savers, for people around the world. They just need to own gold and silver because over broad sweeps of time, both have preserved purchasing power of a currency. So that's what's going to happen. I think the end result is going to be some type of a monetary reset to reestablish credibility in fiat currencies, and that will demand some type of a reattachment, I believe, to gold.
Well, that's interesting, and I do have a question on that, but we'll come back to that in a moment. President-elect Trump has said that he wants to impose tariffs on any country that's going to ditch the U.S. dollar, on vehicles coming in from China, including other items, as well as many other things. Do you see tariffs as inflationary, and how do you expect them to affect the precious metals?
Well, they are inflationary in that they will likely raise retail price. So it's price inflation. It's not necessarily monetary inflation because you're not having an inflation of the amount of currency in the system. You're just having to pay more for goods. So the real world effect will be the same as monetary inflation in that you'll see the symptom of price inflation to some degree. Now, I don't think he's going to be able to enact the most grandiose of his tariff plans, but there will still be some effect. And that's going to frustrate, I think, the ability or the efforts of the Fed to try and stem off inflation through interest rate policy.
So, Brian, there's a Deutsche Bank model, I'm not sure if you've seen this, that shows a direct correlation between federal debt growth and gold prices. It establishes a near 1-to-1 percentage relationship between the two. Simply put, increases in federal debt pushes gold prices much higher. What do you make of this 1-to-1 correlation between debt and gold prices? Do you see a massive debt expansion regardless of the cost-cutting efforts by the Trump administration?
Yeah, I've long observed that the relationship between debt and gold prices, although gold tends to trade sideways or just kind of languish when people aren't really worried about the debt. But when they are worried about the debt and the implications for the purchasing power of their currency, then they start seeking gold, and then gold responds. So I've never observed it to be much of a direct 1-to-1 relationship so much as gold tends to make up for lost time, and in some cases even overshoot equilibrium as people really get concerned at certain periods of time. So yeah, I think that's definitely a relationship. Now, as to whether they can do much about it in terms of cutting spending and reducing the deficit or the debt, I really don't think there's much they can do. There's only about 25% of the federal budget that is discretionary, that isn't on autopilot. So, even if Elon gets in there and is able to cut that part of the budget by half, which I don't think he could do, you're still only talking about 10% or so of the federal budget. So I don't think that they'll be able to do much at all. I applaud their efforts. I think they're needed, but I don't think it'll do anything to derail the oncoming monetary reset that I think will be necessary at some point.
And of course, each of the departments, Department of Education, Department of whatever, each of those has bloat in them. However, they're led by people who can scream loud and by people who have jobs who can scream loud. And it would be awfully difficult to go in there and just chop that up, wouldn't it?
Yeah, it would. Musk is talking about, that are trying to assuage the public fears that it won't be that dramatic, and that in any case, the people that would be cut would be offered generous severance packages, so they really wouldn't have to work for a couple of years, and in that span of time, they could hopefully retrain themselves to, run at least a lemonade stand or something. But so it won't be that abrupt in terms of either, disruptive toward the economy, disruptive toward those people who were laid off, uh, and actually, much of a cut in the budget for a couple of years. It would be very tough to do. But again, I think something needs to be done, but I think it's going to be more of a feel-good effort than anything else. Politically, it'll be really tough because politicians are, they want to get reelected. What I have more hope in is the talk right now of a constitutional amendment for term limits. That would be interesting.
Yes,
And I think that would be really effective, but remains to be seen what kind of public support we could drum up for that.
So you're talking about this monetary reset. Let's go back to that. Dr. Judy Shelton, you've probably heard that name, was an economic advisor to President Trump in his first term. I've heard her name being mentioned for upcoming open FOMC positions to be appointed by President Trump coming up. Dr. Shelton is on record as having said the following: I want the United States to be the leader if there's any kind of gold backing to a currency. In his acceptance speech the other night, President Trump said that he's going to lead the U.S. into the next golden age. The BRICS are buying record amounts of gold. What do you see coming here for the global financial system and for the dollar? And is any of this related, or is it just coincidental, talk and action?
Yeah, it's all related. And, I know Judy. I had the pleasure of having her speak at my conference a few years back, and expect and hope to have her back in the future, hopefully as a member of the FOMC. I think what frustrated the efforts to get her on board before was a divided Congress. Over the next couple of years, that won't be the case for Trump, and I think he would be able to get her on board, and hopefully he can. So yes, it is all related. I do think there will be a reset necessary at some point to reattach currencies to gold, but the whole BRICS thing is entirely different. That's other countries around the world trying to gain some independence from the dollar hegemony, and the dollar weaponization that we saw in particular after the Russia's invasion of Ukraine. A lot of the countries that are now looking for alternatives or trying to insulate themselves somewhat by buying gold were actually part of the coalition putting those sanctions on Russia. But still, they recognize that at some point that weapon can be turned on them. And they, not coincidentally, they all started buying gold hand over fist right after those sanctions came about. So that's obvious. We know what's going on there. Now, as far as BRICS moving to a non-dollar standard based on gold, I think they would have to base it on gold because none of those criminal regimes in some cases would ever trust each other unless there's some kind of a steadfast, hard and fast attachment to gold. But I don't think it's going to happen anytime soon. And I don't think that while the trend is obvious, I don't think that the dollar is going to lose its reserve currency status at any point that any time frame that makes any sense for us to worry about. It's far down the road. I think the trend is headed in that direction, but it's got a good ways to go, and it's nothing we need to really concern ourselves with in the near term.
Maybe, excuse me, maybe the more important point in the whole BRICS equation, though, is the gold purchasing by their central banks and the ultimate demand that they're creating, which is going to create a floor for gold prices.
Absolutely. The central banks, they at least in this case, They're buying gold, they're socking it away, and they're in there for the long term, and they're not really price sensitive. They're concerned, or they're watching the percentage of gold reserves in their reserves, and as a percentage of their total reserves. They're not really that concerned about the price. So that's steady buying. And that's why for the first 6 to 8 weeks of this bull market, we saw a steady ascent in the gold price with really hardly any variation, hardly any rest or at all. Since then, we've seen more Western involvement in the market, and therefore that brings in a lot more volatility. It has interestingly created a fairly regular ebb and flow in the market that we've been tracking in Gold Newsletter as a big aid in our investing recommendations. And I don't know how long that that consistency will last, but for now, it's been extremely consistent and something that investors can really watch very closely.
Brian, in your analysis, what are the strong variables that this precious metals bull run is built on, and have they changed just because of the election? In other words, has the results of the election changed anything regarding the thesis for gold?
No, not at all. I was consistent for months before the election when my Canadian friends and Canadian media and international media asked me about what the effect the election would have on the gold price, and I would answer in every case, not a bit. The fundamental drivers for gold are laid on a foundation of ever easier money, a trend of ever easier money that's 45 years in the making. And I think we're in the end game of that trend right now. I think either this crisis and rescue cycle or the next crisis and rescue cycle or the one after that, at some point, it's going to get embedded in the public consciousness that there's always another crisis, and the response is always a massive unleashing of more and more currency. And so with each one of these cycles, the public's faith in that currency is diluted further and further. At some point, again, I think that credibility is all but gone, and we're going to need gold to reestablish it to some degree.
So you don't envision a future crisis, whether that's, within a year or within 5 or 10 years, you don't envision a future crisis where the Fed would allow the basic laws of supply and demand and business cycle to take hold, and whatever the effects of that would be.
No, I do envision another crisis. I think that's baking the cake. The Fed blows up its own bubbles with every rescue effort. There will be another crisis, and the Fed will react as expected, but with rescue efforts that are a multiple of anything they did before, because they have to increase it every time to get the same effect. But no, the Fed, as it is, being a political animal as it is, as much as they claim it isn't, they will always come to the rescue. They will never let the curative effects of a free market go through and cleanse the market from all the excesses. They won't let that happen. And if they try, the market will then exacerbate the situation until the rescue efforts materialize. So, no, they're not going to do that. They are going to continue to manage the economy by setting the price of money because they can, and of course, because they know better.
Right. So there's also something to consider that I'm sure they are very much aware of, and that is the laws of diminishing returns. And so I believe that at this point, the laws of diminishing returns showed that the last bailout during the pandemic only produced 50 cents or so on the dollar for every dollar that was printed. And it implies that the next go round will be that much lower.
Yeah, and you're very charitable in assuming that they're aware of that, or at least they pay any mind to it. But it doesn't seem like they do because they still throw more money at the problem. So if it takes, $3 of monetary creation to create $1 of economic effect, they're going to press their keys and they're going to create three new dollars. It's the only tool they have, and they're going to use it. And well, that along with interest rate policy, and this is a new tool that they have, essentially of being able to create funds like that or to that degree. So yeah, they'll do it, and that's what they are. That's what they do. And all we can do is be aware of that and prepare for it. And we're in the right sector for preparing for it. It is something that gold and silver have proven to provide protection against, and that is not anything new. This is the same story that's been repeated in human history time and time over the millennia. And we know how to protect ourselves.
So Trump won in a resounding victory on Tuesday, and on Wednesday, gold and silver plunged really hard. The Fed then announced on Thursday that they were cutting 25 basis points, and gold and silver had a huge up day. Not quite as big as the plunge, but it was still a very big day. In your analysis, why this massive seesaw action in the metals over these couple of days?
Yeah, I don't think the rebound the day after the Fed decision was due to the Fed decision at all. In fact, I think the initial sell-off the day after the election was due to the belief or the perception that there was a geopolitical risk premium built into the gold price. There were fears in some quarters, unfounded in my opinion, but still real to the people who held the fears, that there would be great political violence following the election if Trump lost. Now, fortunately, we had a clear-cut winner, and there aren't really many or any credible claims of rigging or fraud. So the day after the election, the traders looked at that removal of that perceived geopolitical risk, and they sold gold, and they just jumped on top of it and drove the price down through sell stops and forced it lower by shorting the metal. I think that was a one-day phenomenon, and I think cooler heads prevailed, saw that was an overreaction, understood what the longer-term factors driving the gold market were, and even those people around the world who were buying gold because of their real concerns about the U.S. ability to service their debts, they jumped in and bought it on the decline. The gold went on sale, and they took advantage of it. So we've seen that rebound since to some degree. It's down as we're talking today, but I think we're going to trade sideways and continue this correction. I mean, remember, we had weeks of tremendous surge in the price before all of this. So I think what we're doing right now is simply we're in another one of those cycles where we're just digesting the latest rally and getting ready to rally again.
I'm glad you just finished with that because that's a great lead into this next question I have for you, Brian. So gold broke out earlier this year from the previous high of about 2070. It hit a high of just under 2,800. It's since pulled back, as you just mentioned, sits a shade under 2,700. On the way up, it's had multiple legs of moving higher, followed by a slight pullback and a consolidation period. We very well may be, as you just mentioned, in another one of those consolidation periods right now. Gold's been strong all year. All dips have been ultimately bought in 2024. And the trend is usually your friend. So do you see more of the same for gold moving forward in terms of this trend, consolidation up? And when is your analysis pointing to the next up leg beginning?
Yeah, and keep in mind, I could be proven wrong at any moment, but that indicator that I had talked about earlier, that's shown how regular these cycles have been: rally, consolidate, trade sideways, rally again. The indicator I've been watching are gold's Bollinger Bands, and more specifically, the width of those bands. It's very easy to chart through a number of services, and we're doing it for our readers now. But if you just plot a chart of the gold price with the Bollinger Bands and then have a panel that tracks the width of the Bollinger Bands, you can see whenever those bands have neared a peak, in other words, their width has maxed out, that has predicted very consistently over the past 6 or 7 months an imminent sell-off, an imminent correction, or sideways action. And conversely, when the width of the Bollinger Bands has bottomed, in other words, the bands have pinched, it's predicted very consistently an imminent rally. And right now, the width of those bands are falling. It's rolled over, and I think it's within a week or maybe two of bottoming out. More recently, in the last couple of months, that cycle has only taken a few weeks really to run through. So I think we're about a week or two away from the next rally in gold. Now, I hate to make a short-term prediction on the price because that's just asking for trouble. The short term in terms of the metals markets is the hardest to predict. We can have great confidence in that long-term picture for all of the factors we've just discussed, but it's the short term that's the tough part. But we'll see. I think we're getting ready, though, for the next rally.
That's fair. All right, so the previous two big precious metals bull markets, they lasted about a decade each. The first in the 1970s and then the second in the early 2000s. Mm-hmm. Many analysts are saying that we're now in the third big metals bull run and that they expect this one to also last about a decade. Do you view that the same way, that we're in the third big metals bull run? And do you view when do you view the beginning of this current precious metals bull run having started?
Yeah, I disagree with that, but only slightly. I count 3 bull markets in gold from,
the Great Depression time frame.
No, I look at the early 70s and the late 70s as 2 different bull markets. We had a bear market, 1-year bear market in 1976, where the price went from around $200 to $103, which certainly qualifies in my mind as a large enough drop over a long enough time span to qualify as a bear market. But if you divide it thusly into early 70s, late 70s, and then the 2000s, you get 3 distinct bull markets where the price of gold rose anywhere from 5.6 times to 8.2 times from the low to the peak. And that's the kind of comparison I look at right now to try and judge where we're going in this market, because we are in literally uncharted territory now. If you assume that this is a major secular cycle and we're going to do something similar, then you have to look at the bottom for this cycle, which I put at around $1,050. That would be in December of 2015. So projecting that, then this cycle, which has already been underway for quite some time, still will end up with the price of gold somewhere between, say, $6,000 and $8,000 or even higher dollars per ounce. I think that's where we're headed. It feels like we're in that kind of a secular, monetarily based bull market. Now, the key, of course, is the timing. Is that going to happen in another 3 years, 5 years, 10 years? Who knows? All we can do, I think, is hope that it's going to last a good long time, because that will allow us to make the maximum amount of money from this trend by the associated investments in mining stocks and the like.
So, Brian, 71% of institutional investors hold 0 to 1% of gold assets, and the Western investor has largely been absent from gold ownership during this time frame that it's gone up. In your analysis, what will ultimately make the precious metals bull market become more obvious to both the institutional and the generalist Western investor?
Well, you need a few things. You need the gold price uptrend to remain intact.
On the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews, just like this one that we conduct, they're all up there. When you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History nor Economics. This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Brian as much as I have. Please let him know, hit the like and subscribe button, and leave a comment below the video.